Hey guys, welcome. I'm really happy to have back Alden of linalden.com. That's with a single N. Lynn, happy Christmas. Merry Christmas, I suppose I should say. And thank you very much
Merry
for coming
Christmas
back.
to
How
you,
are
and
you
thanks for
doing?
having me back. It's been a relaxing time.
Much to ask for you. I'm sure an hour will go really, really quickly, and we're going to start on them. I suppose the macro markets. We've got to finish with a summary of some forms of how we should position. But there's so much to consume. Maybe you're big and for us. We're coming in with a certain tailwind and headwinds of varying varieties. What were your biggest lessons that you learned? Where were the biggest adjustments you had to make as a result of what went down in
So I would say
2021?
2021 and probably adding fiscal stimulus as it relates to markets. Increase in money supply is very different than what we saw in response to the 2008, 2009 crisis, and really in response in their professional career. Last time that happened, and so it's one of those things you had to crack open the thing and things like that. That only does so much. It has certain impacts, but it's not very impactful, especially for the broad economy. Whereas if you combine programs like loans that turn into grants, things like that. If you just kind of directly spend money into the economy, then you get some effect while it happens, and it's very inflationary. And so there were a lot of people saying, for example, that without bank lending you can't get inflation. Well, the other lever, that's one of those things that's true 90 some percent of the time, but long as that kind of money supply growth lasts. It's not necessarily forever, but it gives you a big jolt upward. And then there's permanently more money in the settle down. And for example, once the semiconductor issue gets fixed, used car prices can settle down. A lot of this is going to settle at some permanently higher level. So I think that was kind of one of the biggest takeaways. I think in terms of kind of a big rotation of markets without any sort of catalyst or any sort of kind of big change. And so, for example, you went almost straight down, and there was no. But besides that, there was no massive event that caused this big rotation, at least. And then they just thought, wait, that's way overvalued, and no one wanted to put capital into it. And then, so it all kind of compounds very quickly. It's amazing how things can change very rapidly when they seem so consensus early on.
Element was that as long as it was going through the banks, it didn't seem well. As you pointed out, I don't know if it gets reined back, but that it'll flatline and not go any higher as a result.
This high of inflation, then when it came, they're kind of changing some narratives around, which is good. I mean, both inflationists and deflationists kind of have to change as the data come in. And so, but I think it's one of the, for example, in
Yeah.
kind of mid early 2020 when you had disinflation, you had lockdowns, and that was of course you wanted to go the opposite direction. You wanted to buy more inflationary assets. You wanted to buy stocks. You wanted to buy things. But we'll see. As part of it comes down to how they measure it. Um, you could have people saying, "Oh, we're about to go into hyperinflation. We're about to, inflation's going to keep going up." When that's ironically when you could start past we're past like the spring 2020 base effects. But there's another set of charts, right? So the month over month inflation really kind of kicked into high gear, and so that's kind of set to happen in quarter one of next year. So I think that year over year inflation spikes that we saw, the thing that's still driving inflation higher, at least headline CPI we'll call it, is the housing component. Because if you look at actual home price increases and you look at actual rent increases, they're much higher and with less volatility. And so, you know, we still have another couple quarters, I think, of the housing components in CPI and the semiconductor shortages, because we have a weird divergence where manufacturers have extremely high inventory because they have all these finished cars sitting there that they need a couple semiconductors to cars to the market, and that should alleviate the big spike in new and used car prices that we've seen and other things, as well as those month over month base effects and some of the stimulus.
It's interesting that you're using almost autos as a bellwether there for take you into the markets. The dollar was maybe the slight surprise for you, if you were talking about anything else you want me to show on the share there. But the dollar got to round about the lower the high 80s, just sub shoulder basically that's taken place. And I'm looking at it, and it seems to us that it's worked its way well back into the mid range. We have a scenario where we're seeing it continuing going higher, not a runner or an absolute ripper, but going higher. And I think this is where you're interesting in that for now, in dollar strength, round about here in it was the March period, possibly relating to the pandemic, or just before that when there was the squeeze September October, we were already quite high up with regards to the problems with the repo rate and the bank liquidity. Give us your points as to how you stand on the dollar, because I want to go from FX markets, try and understand which is going to be the big movers, because this is going to have bearing on all the other markets. Debt markets, they're all obviously related. What happens on equity indices, and of course crypto. I've noticed Bitcoin is more affected now when it's not in an over dominant strength position by the dollar strength positioning. So where do you stand on the big
So
greenback?
currently I'm neutral for in the tactical sense. Index is very euro heavy. And the euro, the ECB lowest central banks to initiate any sort of kind of tapering plans. And so when I take a step back for a second and kind of go over the pattern, I turned bearish on the dollar during that repo period. Shortly after in October 2019, dollar index was about 99, and we started to have that dollar down period. But then when COVID happened, we got that curveball. And so I kind of monitored that spike, and then as I expected, that spike was responded to, and things rolled back over, and so we went down to these pretty bearish levels. Now I try to avoid consensus or kind of positioning when it gets extreme. And so, for example, in late 2020,
Yeah.
even though my longer term outlook was still dollar bearish, I was like, well, now there's so much positioning for dollar bearish outlooks that I wouldn't be surprised to see 6 months of a counter rally or something like that. And so I turned neutral and just said basically like I want to see this kind of shake out for a period of time. I don't really have a high conviction. Now the part that surprised me was that after it did chop around for then several months, but then it did start to break above certain levels that I would have expected in the second half of the year there. And so when it broke above those levels, I said, okay, I'm neutral for the moment. We got to see how this plays out. And I think a lot of what's driving it is at the same time you have the United States was stimulating, you had China was contracting, and kind of cracking down on a lot of its
Yeah.
mega cap stocks, so you couldn't put capital in China. And a lot of capital overall was just flowing to the United States. And so if you want to buy U.S. equities, you obviously need to get dollars. And so there's been a lot of just money
Yeah.
just shoved into U.S. markets. Basically we have higher valuations than the rest of the world, even on a sector by sector basis. If you look at the MSCI ACWI index, it captures most of the world market. The United States is over 60% of that entire index, even though we're 20 some percent of global GDP. And so we've really kind of shoved a lot of capital into our equity market. And so that's been dollar strong. So I think going forward, you could see a pretty significant kind of correlation there between the dollar and the equity market, in the sense that if the equity market runs into trouble, you could get kind of some stagnation in the dollar index. And so, overall, I think that relationship could change relative to some prior things. But for now, I'm neutral because with the ECB as kind of dovish as they are, and the Fed tightening, that does, you know, kind of continue to at least fuel some kind of dollar neutral to dollar bullish outlook until something breaks, until it causes some sort of spike that would maybe force that situation to reverse again.
Yeah. Yeah, that's interesting. We've retraced about 50% from the all-time high when we went to a 103, which was a blow-off spike. So it was quite a stretchy high. We ran down to 89 and we're sitting at 96, which is literally, we're spinning tops on the 50, which is quite I suppose, a seminal event. It's quite an interesting one. You also mentioned China. So one of the shocks of the FX markets for me was during this period that we've got dollar reflation and strength. And we've had the euro coming back. One of the few currencies that the dollar didn't perform particularly well against was the CNY, the Chinese yuan. And I'm just curious, we could spitball, we don't know, but what your guess would be if I bring up the USD CNY for you just to see it. Over this time, we've seen it come back from around 7.1. We know there's lots of pegging, there's lots of, mixed economy doing a lot of management, and it might be basing out now, but there was a substantial period of strength here for the CNHY here, coming down from the 7.1 to where we're at the 6.3s. Do you have an idea as to why
Well,
that
one
might
is
have
that
happened?
they did a lot less stimulus than the U.S. government, so they increased their money supply at a slower rate than a number of other countries.
Yeah,
And they actually, I mean, they let bankruptcies occur, like a kind of a weird phenomenon these
yeah,
days. Yeah, and
Evergrande.
others too. And so, it
Yeah,
was very difficult to be in their equity market, but for example, their sovereign bond market is relatively attractive on a numbers basis compared to many others. Basically, the real yield situation, how much yield you get compared to how tightly they're holding their money supply and things like that. Now, there's some politics around that. So, for example, in late 2022, you have the National Congress of China, where the president is seemingly aiming for a third term, which would be unprecedented in modern Chinese history, kind of a consolidation of power. So, kind of cracking down in 2021, deleveraging to some extent, and then probably stabilizing and re-stimulating into 2022 makes sense. Yeah,
for
for
election
what is
season.
essentially what the
Yeah.
closest thing they have to election season, we can call it. And and so basically they don't. I don't think they want to be like mid crackdown during that, right? They want to get the hard parts out of the way in
No.
2021, and then 2022. I think there's a case to be made. If you look at the Chinese credit impulse, that's showing potentially signs of bottoming. Um, and so, this was a strong year for the currency in China and a bad year for almost any other asset in China, right? You didn't want to own real estate, you didn't want to own equity, you wanted to own things like their currency and their bonds. That could potentially reverse it somewhat in 2022, where some of their risk assets might improve a little bit from these beaten down levels, whereas their currency might, be a little less strong than it was in 2021. I think if you look at ultra long term, kind of tying into why I'm kind of long term bearish on the dollar, mainly relates to the whole trade deficit issue, where the strong dollar is ironically kind of really hurting American industry. It makes it very hard to have any sort of physical production in the United States compared to many of our developed peers and emerging peers. Whereas China, for example, is now kind of trying to shift from an export driven economy to a more balanced economy. And so I think that eventually they're going to switch from a current account surplus to, kind of a mild current account deficit, a more consumption driven economy, and that's kind of necessitates a stronger currency. So I think longer term you could see dollar weakness and yuan strength as you normalize some of these trade balance issues and things like that. But that's a long arc of time type of macro shift, whereas the more tactical
Mm.
thing is just kind of just like as you pointed out, as we discussed, the Fed's tightening more than the ECB. The dollar index is very euro heavy, and that's why I think you can get, dollar
Yeah.
strength. It's also just again a matter of where capital wants to flow to. So if capital wants to just shove into U.S. equity markets and just prop up the big FANG stocks, that's going to be relatively strong for the dollars as long as that persists. But as we saw from say the ARC stocks just reversing very quickly, you can get a pretty rapid uh, kind of change in the types of investments investors want to hold. And so, for whatever reason, they decide that the U.S. mega caps are no longer attractive. That could be a relatively bearish catalyst for the dollar. It's just that we're not there yet, and there's no signs that we're going to get there in, say the next 3 to 6 months.
Yeah, I brought up just on that the Shanghai Composite Index on a weekly time frame, and it does seem you referred to coiling. We have our own naming standards for this, but it does seem like there's a structure which would point to quite a buoyant equity market for the Shanghai Comp, at least. Anyway, this is a weekly chart, and there's a couple of little squeezing moments. I mean, it could come first for a down leg before coming up. But yeah, it's just interesting because that could I suppose dovetail with some offshore interest and it maybe could support your hypothesis of a bit of a bid under the Chinese yuan if offshore money starts going into the equivalent of FANG in the Chinese market anyway. Yeah, great. So that's kind of FX markets, debt markets. What do you make of it? I mean, let's ask the question. Bond markets are distorted by the fact that the Fed is monetizing. So when we get a signal out of the bond markets, we can maybe see it as a proxy in terms of how the change, but the absolute value of a bond with a negative real yield. I'm curious to what you think, given that this process is going on, and I think this isn't just America; it's probably bond markets generally, that they've been over supported, they're overvalued. We should be in a much higher interest rate environment, hence all the default by negative yield, real yield in terms of inflation. Just as a general market, because most people, retail doesn't understand the bond markets particularly, but maybe there's a lesson that they should. What's your take on yields? I suppose it brings us to the bigger question of, will the Fed get out on their whole plan will they do three tightens if that's what's been priced? And I think you were saying already that the bond market was pointing to the fact that potentially it doesn't believe the Fed and it's calling its bluff, which we've often done as well. So if I'll just bring up, for example, the yield on the 10-year, and this is the chart at the moment. I'm pretty sure you're familiar with it. Treasury note yield. Is that going up, as we're indicating here technically, a squeeze to the upside, or will it only go so far and then we're ready for our next deflationary shock, a banking hack, who knows, some other events, or other point of failure because we're such a fragile system? What's your take on that, debt markets and how
Well, I
things
think you
roll from here?
described it well, and that's a similar phrasing that I've used, is that the bond market can tell us the direction of the bond market is useful information. The absolute value of the bond market is very, kind of manipulated, right? And so I don't really get a lot of information about, I like if you look at mid 2020, for example, the 10-year Treasury was like 0.5%, and uh, literally in like the next like 18 months, like all 10 years of coupons you're going to get from that bond were already outpaced by inflation, official CPI. And so basically the bond market
Yeah.
wasn't really telling you anything about future inflation, even though the direction of the bond market can be useful. The absolute level is controlled now by the major central banks. So whether it's Japan, whether it's Europe, whether it's Britain, whether it's the United States and other developed countries, they do a lot of control. And so it's that old saying when when a like a target becomes like a goal, when a measure becomes a target, it stops being a useful measure, right? And so it's one of those things where it's useful to watch, and it's very important for a lot of macro assets, but it's there's kind of weakened inflation informational value in it compared to how it used to be. And so there's a couple things to watch. One is I do think the Fed is going to tighten for a period of time. I do think they're going to complete tapering, and I think it's possible they can get some 25 basis point hikes. And I don't have a strong view of how many, other than I don't think it'll be too many. And I think you're basically going to, my overall kind of long-term view is that the whole 2020s, you're going to spend the most of the time in negative real yield territory, for most of the bond curve. And that was, for the short end of the bond curve, that was true for the 2010s decade as well. But there was that brief exception in, that 2017, 2018 period where they briefly got the Fed funds rate over official CPI. And it broke the markets and they had to reverse back down. So I think you could get another moment like that potentially, where they're going to try to tighten gradually until something breaks. And there are a couple of things that can break. One is if the dollar spikes too hard, and starts causing foreign sector to sell treasuries, you could get a yield spike, and then you could get like a liquidity problem, like you saw back in March 2020. Maybe less severe, but still, if the world's deepest, most liquid market has a liquidity problem, that's an issue. And so you could see the Fed have to kind of unexpectedly come in to address that. Another potential issue is if you get the yield curve inversion. If they try to taper and then they
Yeah.
start raising and then it inverts the yield curve, that's kind of the situation they ran into in 2019. Or another option is what they ran in 2018, which is when they were hiking into that and reducing their balance sheet, credit markets froze. So a lot of people point to the S&P 500 because the S&P 500 fell 20%, roughly in quarter four 2018, and they say, "Well, oh, look, the stock market fell. That made the Fed reverse." But really, under the surface, that was like that was like the part of the iceberg you could see over the surface. The bigger, worst part of the iceberg under the surface was that credit markets froze, And so, for example, there were no junk
Yeah.
bonds issued for 6 weeks during a long stretch in like Q4 of 2018, and so that kind of necessitated them backing off from their tightening plans. So I think essentially that the Fed's game plan here is to very gradually tighten until either something breaks or you start to get, say, a headline CPI start to go down significantly from those headline numbers, either because semiconductors got sorted out or something like that.
Yeah, I'm in the something breaks camp. I'm not sure they're going to get anywhere close to the three, just because they're getting deeper and deeper into the cookie jar, and the hand is getting
Yeah.
fuller and fuller, and it's going to be real hard to extricate themselves from that. But you're quite right. They could supposedly achieve some of their objectives. There's a talk of a new measure for inflation, I think, in the new year as well, which could be lies, damn lies, and statistics, a new method for masking somewhat the inflation. Because I think if you're on John Williams's rate, which was the Ronald Reagan 1982, we're already at the levels that was the bond highs 1982, where we should officially have rates somewhat equivalent to that, which would be absolutely devastating for debt markets. And of course, what many people don't understand is pensions, which is why I love doing this with you, because we go from the macro markets down. And as you quite correctly said, it wasn't an equity market thing, it was the debt market thing. I had puts on the junk market, and the Fed came out and backed the ETF that I was short, which I was pretty grumpy about. It was, I think, JNK or high yield, HYG, sorry. And they just said, we'll hold up the other end. It doesn't matter how crap it is. We'll keep that ledge from dropping out of pension grade into the lower grades, which is just shows the degree of manipulation we have. They just don't want that low value but not yet junked level to topple down into the next level, because it'll precipitate a selling wave on the pensions funds
Yeah.
and many other things.
Yeah, that's a big thing to watch.
Great.
Basically, any of those breaking points. And one thing is they are aware of those. So each time they get a little smarter in the sense they learned something, right? Even though they're getting themselves more into a trap, almost by necessity, they have to fine tune things. And so, for example, what they learned from the March 2020 Treasury sell-off is that they don't want that to happen again. And so now they have these standing
Yeah.
repo facilities in place, including an international version, and they set that up at a time where right now they don't need repos. Right now there's reverse repos. It's the other problem. Um, but they're trying to be forward looking and expecting that the next time, maybe you get a dollar spike and you get a treasury sell off, that they already have certain facilities ready to go to absorb that and to give markets the signal that so that the markets know, like at least the market, the part of the market that needs to know, that knows it's there, which can then maybe smooth some of the impact ahead of time. And so you could actually get a situation where something starts to break, and so you get weird behavior out of the Fed, like for example, they start doing repo activity, yet still trying to signal rate hikes or something. You could get kind of these almost like taking liquidity away from with one hand and giving it back in another hand. And so
That's so interesting, because one of my questions was, could we have fuel on one end of the fire and water on the other? I was going to actually ask you that very question on the basis that they want to give the impression and virtue signal, if you like, a rate hike cycle. But because of the problem with the debt markets, continue to monetize and maybe even have a period where they have to add to support another of those September, October 19 moments by being the buyer of last default of toxic assets at the same time. So it's very interesting you brought that by. I want to get onto commodities and equities, because that'll bring everybody back into the room. Some people, their eyes glaze over when you talk about debt markets, wrongly, I think, but equity indices and commodity markets would do maybe together. But I know where you stand. If the rate cycle on interest is tightening, the growth, the Cathy Wood ARK investments, particularly the high beta, high growth, no dividend, no earnings, people forget now that some of the FANGs are actually, they've got massive earnings, and then I think in some cases, are they dividending? I haven't got it off pat. Is that correct? Are there any that are dividending, and at what rate
So
of the
Apple
big
pays a
major
meaningful
FANGs?
dividend, but because the valuation is pretty high, the dividend yield is very low. Microsoft also, it's
Yeah.
not technically a FANG stock, but it should be. Basically, Microsoft pays a dividend, whereas Google and Facebook and Amazon do not, and neither does Netflix and some of the other big
Yeah.
ones.
Yeah, yeah. So the big one, I recall, I think Warren Buffett gets about 800 million a year on his Apple holding, if he's still holding it, which is quite cash generative. But as you point out, the value is so high, you're paying a massive amount for that stream. But it's pretty assured, which is probably the trade around which that's probably our true bond market in that sense, in terms of the interest rates and what people see as low risk of failure, because I think the current debt markets don't fall into that category. So, how are you positioning, Lynn, in terms of equities? Let's talk household names people will know, or miners. We're going to bring in energies. I'm very bullish energies. I understand you are too. There is a dollar element to that. We've had a pullback on oil. We've had some pullbacks on natural gas and also lumber. We can mention all commodities in this. How are you on the commodities, and any plays? Would you go with them directly in the commodity market or an ETF, or are there some equities that you really like? On the outside of the tech growth sphere, I'm sensing you're not going to be too
So
heavily
I'm
weighted
fairly
there.
bullish on energy, both the producers and the transporters, and buying, say, long dated futures for it, for oil. Um, Now, my general approach here is to fade these parabolic spikes. And so when we got the lumber spike, I was like, okay, I'm bullish on commodities, but I'm not bullish on this spike. Same thing with the massive natural gas spike in Europe, for example. That gets so bad that
Yeah,
eventually it gets fixed one way or another, even though it can be a very difficult process.
yeah,
And so I would fade these parabolas, but I think that the longer term view is that because of limited capex for a variety of reasons, energy markets are going to be tighter than we've been used to over the past 5 years, where they've been extremely loose, right? So basically, U.S. shale disrupted the global energy market. A lot of it was unprofitable.
immensely.
So we basically were
Yeah,
just throwing capital, lighting it on fire, getting more and more oil to market unprofitably. It destabilized the whole oil market. But now that you have a combination of investors are tired of losing money in shale, for one, instead of wanting to see growth, they want to see capital returns from shale producers. They want to see things like buybacks. They want to see dividends. They want to see debt reduction. They want to see discipline in their drilling. And two, you have ESG mandates. You have a lot of pension and sovereign wealth fund capital just won't go into that space, which again forces those companies to be more self-sufficient. Instead of constantly issuing debt and equity to fund their operations, they have to fund out of free cash flow. So they can only drill when it's profitable to do so. For the most part at least. And so,
yeah,
uh, with that combination, and then OPEC's being relatively disciplined, and when you see that combination, I think that gives a certain tightness to oil markets. Now, there's all sorts of things like OPEC Plus can come out with they can raise capacity a little bit. You can get these variants. You can get overbought conditions. And so I've been kind of very near term cautious on oil just because we're in the middle of this Omicron wave, and so there's things like that can certainly give you tactical pause. But when I look at multiple years, I'm quite bullish on the energy sector, and I think there's multiple ways to play it. So I like some of the infrastructure companies, like the midstream companies like Enterprise Products Partners or Magellan Midstream. I also like some of the low cost producers that are able to kind of just get through these rolling bull markets and bear markets, so that some of the large majors, for example, as well as some of the really kind of the higher end shale producers like EOG. I also like some of the Canadian producers like Canadian Natural Resources, and plays like that. And one thing I do is I diversify in terms of geography, because there are these different pressures on them from some of their governments, and so I don't want to have too much exposure to any one jurisdiction. And then besides energy, I've been focusing on the healthcare sector. We've been seeing a little bit of a rebound in some of there. I haven't really been playing the ETF, but I've been playing some of the names like Bristol Myers Squibb or Cigna, companies like that. And the reason is that part of the it was going to be kind of tied into the Build Back Better bill was drug price regulation in the United States, and so we pay very very high drug prices, and there were reforms pushed through the House to try to rein that in, but a lot of that can't go through the Senate, and so they watered it down to try to get through the Senate, and so the market for a while was pricing kind of a worst case scenario. Then they started saying, oh, wait, the watered down version's maybe not as bad as we thought. And now it's even unclear if the watered down version is going to get in place before 2022 midterms. We don't know. And so we've seen kind of this underperformance for a period of time of some of these healthcare stocks, and they're extraordinarily cheap, many of them. And I think that basically that's a relatively defensive way to have exposure to 2022. And so I do like some of the consumer staples and some of the healthcare names, in addition to the energy sector.
Okay, so energy, some that are not involved in the COVID vaccine issuance of the healthcare. So you mentioned Bristol Myers Squibb and a few others, so that they aren't getting the booster, should we say. But they're in other areas of healthcare where there's likely to be maybe quite a bit of aftermath of people in not so great condition, and they're being a bit oversold because of the uncertainty on the bill, which is now running into well-sponsored politicians that are doing a lot of blocking. It makes very good sense to me. So that's equities. The question everybody wants to know, Lynn, is gold. Bring up the precious metals. Surely, if we're in such a negative real interest rate environment, and I'm going to say, let's say $1 trillion went into Bitcoin that would have gone into gold, and we're at 1.5, and that 100% of that extra $1 trillion because of the inflation. Because I want to take away the excuse, that it's Bitcoin is a competitor. It isn't a competitor, but it's gone up. It's gone up to 2.5. There's institutions now involved. They're playing the game. You can get in. Why has gold been such a laggard, given that it's almost plain for all of us to see? We both agreed that debt markets are being held up largely. They're going to play the negative real interest rate game to destroy value. It must be one of the worst asset classes to be in. You've got guaranteed losses. We're in a higher inflation rate, if you believe than even the numbers are saying. Gold should be back on its bike again. Why isn't it? What's your take? Bitcoin aside, I'm trying to give you no exits here.
So
Give
I
us
think
a
there's a
reason.
couple reasons. So I've had a couple different phases on gold. Some have been correct and some have been relatively incorrect. And so, for example, in August 2020, I started to say, okay, we've got a lot of enthusiasm in gold. We're starting to see real rates, at least measured by the tips market, kind of bottom out for a period of time, at least stop going lower, right? So they hit like negative 1.08%. And ever since then, they've kind of been chopping along in that range, because the tips market has not really reflected the actual CPI we've been seeing. But so that started to happen. At the same time, I was very, very bullish on Bitcoin back in mid 2020. So I was like, okay, I'm very bullish on Bitcoin.
Yeah.
I'm still long term bullish on gold, but like, I think it could take a break here. Now in March 2021, I started to see signs that some of the gold miners and gold might be bottoming out, and that correction could be over. And so I shifted somewhat bullish on gold again. And that's the one that didn't really play out. So the August 2021 played out almost like magic, whereas the March
Yeah.
2020 shift to bullishness, it's not that it was like directly wrong. It just kind of instead just kept going choppy sideways, right? So we started to get like
Yeah.
in April it looked correct. We got like a nice rally in April, and I was like, oh, nice, we got this another call. But then it
Yeah.
rolled back over, and I do so that's the part where
Yeah.
I do think that Bitcoin and some of the other cryptos probably took market share from gold. I've seen very convincing charts that show there's been in 2021 there's an inverse flow correlation between gold and Bitcoin, for example, Bitcoin ETFs versus gold ETFs, things like that. Some of the miners, and so I do think that around the margins, that's been a meaningful kind of suppressant for gold. I think another factor that has to be kind of considered is that with the equity market doing as well as it has been, when you have kind of low rates, money supply growth, and at least the big names have so far kept their margins up pretty well. There's been little reason to
Yeah.
rotate out of equities into gold, even though you'd think more people would rotate out of bonds into gold. But then you have things like mandates and things like that that are make that challenging for them. But for the equity market, because the equity market's been doing so well, there's not been a strong reason to get into gold. Now, I think if you look in 2022, that catalyst could change a little bit because I think some of the wage pressures are still occurring, while some of the stimulatory effects are wearing off. And so we are starting to see maybe a topping out of S&P 500 profit margins. And so you could get a little bit of headwind there on some of the equity markets, I think. And so gold can look relatively attractive in comparison. But of course, one of the tricky things there with gold is that with the Fed tightening, that's another suppressant
Yeah.
variable. So I think basically gold kind of the moment it could have shined, it started to shine a lot in mid 2020. Then it kind of I think got
Yeah.
overbought. And then when it had another chance to shine in kind of early to mid 2021, I think it was kind of that's where Bitcoin kind of robbed it to some extent. And then now it's kind of forward looking and pricing in Fed hikes and Fed tightening. So I think in this kind of period of time, it's kind of kind of stagnating. And I think the next catalyst to look for would be when we prior talked about how when the Fed kind of runs into problems with its tightening, right? When either something in markets
Yeah.
breaks or yield curve inverts or something like that, and they're forced to take a step back, gold could start sniffing that out and then kind of do well to the
Yeah.
upside.
Smelling stimulus
Exactly.
coming down the pipe. This is gold divided by the triple Q, the Nasdaq stars, and you can see what it just doesn't seem to ever put in a bottom. It keeps looking like it's almost there, but it has been an underperformer, even if we include the 1920 period where it did have a little bit of a run. So it does seem a little bit like stocks have replaced gold for now in this huge overperformance. Certainly, stocks in the US have the tech queens and kings. In fact, you mentioned yield. This is a little bit of something I'm quite interested in, and I'd like to show this to you, Lynn. If I'll go back to sharing the chart. I think I'd forgotten to share charts there. My bad. Let me just put it back on there. Let's do that. I missed showing you guys. Let me just take one step back. I wasn't on screen share and just do the gold versus. Yeah, they see it. I just got to get that gold chart back up because I wasn't sharing then. Sorry, guys, for everyone following. So gold's been a big underperformer. This was the point, and this is just what I was showing. And that was our gold chart. Lynn was telling us about this run up in early 2021 that rolled over. And what I'd done is I just divided by 3Qs, which is, we'll just grab that on the NASDAQ. It's got a NASDAQ proxy. And you can see that it's just been, in spite of a couple of stall points, it's been a chart over an extended period that is just going down, down, down. On rates, Lynn, this is where I was going to take you, and we go back to Bitcoin. I noticed something that was a little bit interesting, and maybe you'll give us a comment on this. Because of the negative yield actually game that's going on, could rates actually be a rise in rates actually be, because they're going to lag, they're going to be late, there is a continual broadening in between actual rates, what they should be, and real rates, that actually an interest rate increase, this is the 10-year yield I've got on the lower half, the smaller candle chart, and I'm just going to marry them up so that they are under each other. There's quite an interesting correlation that in actual fact, as we start to get a move up, and let's just make sure I've got weekly there, and this is on daily. Let me do that 1 second. My daily, get these guys lined up properly. You might notice, and I should probably not do Bitcoin off an exchange. I'm going to go Bitcoin futures, so then it's only 5-day weeks as well. So excuse me while I get that chart lined up a little bit. That as the yield is climbing on the lower half, it seems almost to have been supportive for Bitcoin. That sounds like an oxymoron and a stupid statement to make, but because the way I might possibly rationalize this, and I don't want to be a rationalizer, but the way that this could make sense is that because the interest rate hikes are coming late, and in arrears, and the broadening is continuing between the real inflation rate, the negative real inflation rate, we're staircasing, we're largely flat, and then we have a rate hike, it goes up, and then that's it for a sustained period, but inflation is a straight line just broadening away. So that actually with the tightening of rates, we're actually getting okay, we're going to have a clear run again, and inflation is going to continue. In other words, it seems to me the market is pricing in ongoing inflation, at least at these levels, which has an inverse compounding effect against you. And that yield, the sign of yield weakness, for example, it was a great divergence indicator here. For example, we had the rising wedge. Everyone was buying the dip. This was a little bit mania-ish into the 64, but yields were warning you over here, for example, that these relative highs were good exits. And then we've had a subsequent pullback on yields, which is deflationary fear, anti-stimulus, which Bitcoin also has a sort of pro-stimulus proxy in the way we would consider gold. And we've had this corrective period. And then roughly after this double bottom on yields, I've got the 10-year treasury here, by the way. Once we started to reverse off that, it's perfectly in conjunction with this first bottom here, that Bitcoin started to recover. We squeezed a little bit, yields were going up, this helped this surge, and then again, that was your first top there, and it gave you a relative high, and actually this diverged a little bit. You failed to make a new high on the yields, but you pushed a teeny bit higher, again showing overextended Bitcoin. Technicians would have drawn a rising wedge, and then you threw it down with that yield. But this yield correction is not anywhere near as big by measure as this one. Yet you got a fairly harsh corrective play on Bitcoin, and we're now up. We've got a little bit of it's a higher beta Bitcoin to everything virtually. We've got a bit of a down day on yields, and as you can see, we've released a little bit of pressure on Bitcoin. I'm just postulating for contraindicators, and maybe that one will be, I mean, they should be diametrically opposed, but my thinking is the market sees once a rate's in, it's going to be a reasonable spell now before another one comes in. Any comment on
I think it's a good way of
observations
thinking
there?
about it. And it's been the challenge between the actual CPI and the inflation expectations, because the expectations have been managed, whereas the CPI is even though that's also an imperfect measure, that's been more reflective of actual price increases and has been that has not been well predicted by those inflation expectations so far. And so if you look at real rates as measured just like simply by the 10-year minus year-over-year CPI, you're at more than -5% real interest rates, because you're subtracting like 6.8 from 1.5 or whatever the number is right now. And so I think if sticky high inflation were to persist, we talked before about how by Q1 we could see potentially year-over-year CPI maybe peak out. But then the big question is, how long does elevated year-over-year inflation persist? And if the market starts to kind of price in the idea that that's going to be stickier than they thought, you could get that start to reflect in some of these other markets. And so you could start to get pricing as though the negative real rates are deeper than the tips market's currently pricing in. And that would be attractive for gold and other assets. As for Bitcoin itself, the tricky thing about Bitcoin is this, because it's such a younger market and a more volatile market and a just kind of a market that each phase tend to have different buyers, right? So we watched it rotate from mostly a retail phenomenon to a mostly institutional phenomenon, while the retail went into like altcoins, for example. And so that rotation changed the type of buyers. And another thing we've seen is that because China banned Bitcoin mining and then they cracked down on the exchanges, right? So it's still possible to own Bitcoin in China, but it's very, very hard to access it on things like exchanges and large scale mining and things like that. We've actually seen a lot of, over the past, call it 4 to 6 months, we've seen a ton of selling pressure out of Asia, while we've still seen accumulation pressure out of North America and Europe. And so that's set to roughly end in a few days, really, because some of those exchanges by the end of the calendar year are no longer officially serving mainland Chinese customers. And we've already seen, for example, the largest Asian exchange, literally like in the beginning of the year, they had something like they hit a peak of like 400,000 Bitcoins on their exchange, and now they're below 40,000. So that was a huge rotation in terms of where the Bitcoins are held, and things like that. And so I think I a little bit kind of avoid, like, Bitcoin's big enough to be a macro asset now, but there's so many kind of weird correlations that happen with it. So I'm always monitoring who's buying and selling. What kind of entities? Is it longer term people selling or buying? Is it shorter term people? So I still generally see that it's kind of on its own drum, even though it is very tied to liquidity and inflation and things like that too. So it's a very mixed bag in terms of analysis, and that's why I try to kind of attack that analysis from multiple different points of view rather than trying to stick too closely to correlations when it comes to Bitcoin. Whereas gold, gold's got that very strong inverse correlation with real yields. Um, the problem is knowing which real yields to use. That's the biggest challenge. It also has, the dollar has in some cases weight on it, so it is, that's a weaker correlation than with real yields. And I think going forward, now that Bitcoin and crypto market is large enough to be meaningful, that could be another headwind or tailwind, right? So part of that gold April bounce that it had was also weakness in Bitcoin. And so I think it's one of those things where if Bitcoin is absolutely soaring at the moment, that can put pressure on gold. Because a lot of money that might otherwise go into gold is like, well, I'll buy Bitcoin instead. Whereas if Bitcoin flattens out and then Bitcoin corrects, that's a tailwind for gold, even though it's a pretty weak variable on its own. It's got to be it's just one other variable on top of things like what's the dollar doing and what are real interest rates doing and what is actual CPI and things like that doing.
I like that. I think you're right. I think Bitcoin used to dance 100% to its own drum in the beginning. It was all the cypherpunks. It was small, micro cap, 5 million, 50 million, 100 million, sub a billion, etc. But I think more and more I'm seeing it. It seems to have some risk on and risk off asset correlations now. I'll just show you this. This was very much Bitcoin's DNA, but I've divided it by the NASDAQ. This is just taking the
Real
dollar
quick,
out of the equation and
one
putting
thing
a
is I
high
can't see the
beta.
screen right now. Like, yeah,
Thank you for doing that. Start sharing. Let me just hit that up. Sorry,
yeah.
Lynn. Bring you into the room. Apologies for that. I've just put up. So let's state that again. It's this is the Bitcoin and it's the futures. So it's only 5 days. It's not 7 days of data, and it's divided by the Nasdaq NDX, a proxy for Nasdaq as well. So this is kind of taking risk on assets and dividing the two of them. One of the reasons why we really loved this phase and this breakout here is that we felt you were going to get an easy ride with largely green candles. That was what we called this the first cup gold nugget break. So that squeeze was good. But since making this target, if I stay with this chart but just drop the time frame, we've in far more of what we also refer to as a sort of progress decay phase where it's not as clear cut dominance Bitcoin versus tech. And you had a great head and shoulders that was even clearer on the Bitcoin divided by tech in terms of performance than it was against the dollar. And if we just look at today, tech is doing better than Bitcoin. And technically, that's from a TA perspective, I mean, it looks like we've got a lower down leg. So it seems to me Bitcoin as being overtly the fastest horse in the pack was very much the case for our first cup gold nugget break. That was that big pink squeeze that we gave you with that run out. But it seems it's more in a consolidation now. We're kind of thinking it's a little bit out of fashion. A lot of people have got it. It's not having such a great moment right now. It might even underperform tech despite being the higher beta, which could again mean a little bit of fear of risk off, possibly. Maybe the dollar getting a little bit strong again, who knows. But at a later point, we're going to potentially get everything going back crypto again. And then we set up this almost continuation pattern, which will then point to a major surge of overperformance versus the like of equities potentially, which could also be equities going down harder. But I don't feel that. I feel it more them both going up, but the higher beta Bitcoin completely overperforming and dominating the scenario. Do you have a comment on the relative valuations on that? Because that's kind of putting the two markets against us. It's Robinhood with all their call options versus crypto kitties. And of course, as you've said now, structurally, way more institutional money that's
Yeah, I
got
think
into
it's a
the
good way of
space.
looking at it. And so basically the FANG stocks and to expand that, things like Microsoft and things like that, the top NASDAQ names, uh, maybe outside of Tesla, because Tesla's a little bit different than the others, but a lot of those big profitable monopoly-like stocks have in some ways become kind of a risk-off trade. Like they're better bonds than bonds for a lot of people, right? So I do think there's merit in that idea. Bitcoin is interesting because it used to be kind of that the whole Robinhood's asset type thing, whereas now it's more kind of somewhat more sophisticated investors. Whereas you see the things like Doge, or or now it's Shiba, then it keeps changing. But you have like the meme coin of the day. That's more the Robinhood speed, right? They want that kind of thing. And so I wouldn't be surprised to see a Bitcoin consolidation, especially in price and these other things. One thing I look at is some of the on-chain indicators, and I don't necessarily make trading decisions based on them, but I use them for situational awareness to see kind of who's buying, who's selling, what kind of entities are doing it. And so what we see right now is that long-term holders are no longer selling. So generally, when you get a really strong bull market like that period you showed of just constant green candles, where just Bitcoin goes like straight up, you generally see these older hands selling into that market. Because a lot of them have, I mean, not even just that peak, but even just the run up to that peak. They're all those longer term holders are selling into that, and the reason is they have like life changing gains. They're up like they bought coins 1, 2, 3, 4 years prior to that, and they're up 5x, 10x, 20x, and it's a very large percentage of their portfolio. And they want to buy a house, they want to buy whatever the case may be, and so they're selling into that strength. Now, once Bitcoin stops going up and kind of starts consolidating, a lot of those really just kind of the strong hands in the market, the people that really understand the asset class and have been in it for a long time, they stop selling. They say, no, I'm not going to sell at these prices anymore. And so that starts to kind of provide somewhat of a floor for the next kind of this wedge that you drew, right? So generally, when you look up these
Yeah.
longer term charts during these bear markets or consolidations, you see that a larger percentage of coins end up being owned by those longer term, stronger hands. And that that eventually just sucks up liquidity, right? Because those are coins that are just like go into cold storage, and they're not really willing to part with them unless they're up like 3x, 5x, or whatever the number may be. And so that kind of sets up that next phase going forward. So I view it similarly to you, where I'm kind of expecting, I don't really have I'm kind of neutral in the near term, in the sense that we could see a little lower, we could see higher, we could see consolidation. I don't really have, the data is mixed in my view. We have a couple indicators pointing in different directions, but basically the longer it does consolidate, for what we're seeing right now is that more of those coins shift to strong hands that rarely want to sell, and then eventually you get a liquidity shock, and that's what triggers that breakout out of the wedge. And then of course, once you get the breakout, you get momentum traders, you get all these other people dive in, then you get late kind of retail money, right? And so there's various levels of traders jump in. First the smart ones, and then the worst traders, and then there's top buyers, of course, and we get the whole next leg. So I think I view it similarly to how you view it.
It's fascinating. We're at a Bitcoin dominance low ebb, 39.66. And typically we've had some degree of reaction when we've got here. Lynn, I'm hoping that's visual. I do expect this blue level to fail at some point. So whilst I am a macro bull Bitcoin, I do think the use cases are going to catch up. And I want to take you into how far down it have you gone on, the chains, Solana, Ethereum, and the slightly higher flyers. But we may, on Bitcoin easing, get a little bit of a small bounce out of the dominance, on the basis that the altcoins and the higher beta will ease more, faster, fall further, before potentially eventually seeing this 39, 60, basically the 40% level slip, which I do expect to see fail. So that's probably where I disagree. I agree with most of what the people like Michael Saylor espounses about the existing financial system. And I do see Bitcoin as a digital asset rather than a currency. So it's kind of e-gold if you want, but that the use cases in this metaverse. So I'll drag you into, Facebook rebranding to Meta, and this virtual glasses world that we're all going to be sucked in while we own nothing, and we're going to be so happy playing with our Game Boy consoles in this virtual world where there'll be tokenization and gamers play to earn and this entire realm. What's your feeling and take on who might be the winners out of that inside the crypto sphere? Are you in the Bitcoin maximalism? It's the brand that's been there 11, 12 years versus hang on, this is the growth that's coming, and it's clearly well backed. We've got social media spilling into this. A lot of tech equities now. The line between tech and crypto is blurring in that Web 3.0. Just curious to see if this is too high risk for you for now, or what's your views on metaverse and the alternative cryptos, but not the meme. I'm not talking about the pump and meme and the joke tokens. The serious
Yes,
dev
I
teams.
wrote a large research piece on that in the past month that people can check out. It's about proof of stake and stable coins and things like that. Essentially, what I do is I separate, this asset class is now large enough and big enough that, it's kind of like how in equities, there are companies that couldn't be more different and that comparing them is not super useful. In the digital asset space, Bitcoin meets a lot of the properties of money, whereas a lot of the others look more equity-like, right? So proof of stake is in many cases more equity-like than proof of work, and a lot of them pass the Howey test in the sense that they are basically securities, and yeah, and so right
Yeah.
now there's this kind of regulatory gray zone where a lot of these other tokens could be unregistered securities. And in the most draconian sense, you could have, the U.S. force major onshore exchanges to delist anything that passes the Howey test and that hasn't filed as a security and given the kind of the appropriate disclosures about risk and things like that. That's an extreme case. But so I think that there's this issue, especially for institutional buyers, that have to be, retail buyers, they jump in and they kind of worry about the regulations later, whereas larger pools of capital pay more attention to things like securities laws. And so that's why they stuck to mainly to Bitcoin and to a little bit to Ethereum as well. And that they've been instead willing to invest in companies in the space that are working on that because they know those are securities and there's the things like that. And so I think that one risk to watch out for in 2022 and 2023 is that we're probably to get more regulatory clarity on things like stable
Yeah.
coins, on things like decentralized exchanges, on liquidity providers, these decentralized liquidity things, other parts of DeFi, and so I think that's one of the biggest risks facing the industry. Another factor I'd point out is on that Bitcoin dominance chart, that first low that it reached back in like 2017 when it went down to like 40% the first time, that was Bitcoin versus about 1,500 other cryptocurrencies. And the current low that it's in is Bitcoin versus like 15,000 other cryptocurrencies. And so basically, as the number of cryptocurrencies keeps increasing, it's not surprising to see Bitcoin struggle with overall Bitcoin dominance. But the key things I would watch is how does Bitcoin compare to other key large cap ones. So I view things like the Bitcoin to Ethereum ratio to have kind of a little bit higher signal in there. And then as others get big, you can look at, say, Bitcoin to Solana, and you can also do things like look at Solana versus Ethereum as well. And so there are things to watch. I think obviously there are some that are stronger than others. And so, for example, I in my research service, I called for Solana to probably flip Cardano back when Solana was like 40 billion and Cardano was like 90 billion. Um, and it did. 2 months later, it flipped it. They both kind of, Solana got better and Cardano got worse, and they kind of flipped it in the middle. And so, you know, I think you're going to get these rotations like that. I don't think it's really shaken out yet which smart contract platforms are gonna win that race. But at the end of the day, I view them more like equities, whereas I view Bitcoin more like money in that sense. So I kind of just classify them differently and mostly avoid that whole debate about what they're going to be used for, with the caveat being that I do think that the smart contract space is much higher risk, both in terms of technical implementation, competition between the different smart contract chains, as well as the major risk of regulatory crackdown.
Yeah, I'd agree with that. I'd say major risk, but I'd also say it's in the longer run. I think it's the biggest slice of the overall crypto sphere pie. So it's a high risk game but potentially very, very high risk rewards. And I also don't think there has to be only one, although at some point there'll be a consolidation and there'll be one or two. It's kind of like search engines in the beginning. We had so many, and then it kind of came down to two or three. And then Google was kind of the top dog, and you'll have one big dominator and then two or three others, like maybe, I don't know if Yahoo's even worth considering as one, but Internet Explorer, maybe search engines were the right example, but that you're going to have one big winner and two or three segmented winners, but that it'll be a very, very big part of maybe Metaverse 3.0. I like your characterization of treating it like an equity. And you're mentioning that more of the VC money, although Solana went very heavily, 90% was placed VC, but generally for comfort, given the regulatory aspect, better to treat to get involved in the tech stocks that might be behind it and have the dev hive mind. If I'm characterizing you correctly,
I think
is that right?
I think I'm not necessarily recommending that, but that's certainly been the institutional thinking. That they want to know, they want to own things that they understand the legal implications of, and that if there is any risk of securities laws being breached, it's downstream. And so it's possible, for example, that some of the companies that they own securities of, like a privately traded exchange or something like that, that company might face some security laws with the SEC as it deals with maybe having to delist certain tokens. The institutional deployer of capital has that layer between them where they're not directly owning these other types of tokens, that they're not sure how they're going to be treated by the SEC. And so I think that's been a big play. Now, there's a risk there because a lot of the enthusiasm we've seen, like putting aside the meme coins for a second, when you have kind of that, it's kind of like how when you see cities like reaching like the new tallest buildings, that tends to be ironically a sign that market's not going to do very well. You have a similar effect with naming stadiums after companies. When companies and industries start to name a number of stadiums after themselves, that tends to not be the most bullish sign for that industry. And so
peak marketing
exactly.
spend. The dumbest money in the room, peak marketing spend. Yeah, well, funny enough, crypto.com has gone for a sports stadium. It's sponsoring UFC, which I know as someone who's done martial arts, you're aware of, and very big in Formula One, which is an absolute spend fest for marketing. To get yourself on a Formula One car is next level. So yeah, you're probably quite right that there's some proper peak marketing spend on that. Lynn, that's been awesome. I found it very, very interesting. I'm just going to give one or two people a chance to ask a question in here, but just remind everybody if they want to engage with you, how best to do that while I check what questions the chat guys have got for us.
I'm on Twitter at LynnAldenContact, and also my main website is lynnalden.com, where I have a free newsletter. You can sign up. It comes out every 6 weeks, and I cover kind of just major things in the market. So feel free to check that out.
I'm on Lynn's list, and I think you have a membership as well.
Yes,
don't
I
you,
also have a
Lynn?
low-cost paid research service. So the newsletter comes out every 6 weeks and is free, whereas the research service comes out every 2 weeks and goes into a little bit more detail. And that's a low cost, but so it's kind of priced for both retail and institutional investors.
Yeah, I'm on your. It's very good value, and I would certainly make an absolute blind recommendation. Lynn's very grounded, great quality of information, and also not unduly risk gung ho, but always well centered. And you did mention a couple of great calls you made just on that. You did say get out. Uranium was a bit steamy. Sell the super spikes. You did the same with gas. And those are generally turned into, you've maintained your macro biases, but you've also You've also had a sufficiently tactical element to taking off a little bit at blow-off moments, which has no doubt served you very, very well, and it's provided liquidity for picking it up lower down. So I from the sounds of it, I can attest that Linda's been spot on with when markets get a little bit out of hand. And that's the smart institutional money, I think. I personally think crypto got a little bit of dollar strength, a little bit of underperforming tech at the moment, a little bit of a few things. I'm not overtly excessively bullish. I think Ethereum's got a little, we're looking at FBTC, by the way, here, Lynn, which is, you know, the major alts versus this one, but it's a bit flat bottomed. It could be a falling wedge that you maybe get a bounce later, but it does look short term like we maybe dip a little lower first. But actually we have a 10% of a Bitcoin price target. So where, let's say Bitcoin somewhere around $50,000, we do see, if Bitcoin doesn't move, we'll still see ETH in and around 5,000 at some point. So we prefer Ethereum, but at the same time acknowledging its higher beta, and that right now I wouldn't chase in necessarily. You might get a chance to come in a little lower. And in a similar way, Solana too. Do you have a view on Solana yourself at all in the crypto space? You mentioned in your research, I haven't checked recently, so update us on your take on that particular equity, I almost said, but I think you view it that way.
Yeah, so
crypto?
not specifically. I had a call. A lot of that call played out. It's clearly still one of the stronger chains there. It's got a lot of development on it. The biggest challenge to Solana is that it's gone down twice. It's got manual slashing. So basically, the challenge of proof of stake is that you know, Solana runs on proof of stake, but literally there's manual slashing. So developers still essentially control the chain. And so a general tendency in the smart contract space is that you know, these other tokens that are kind of catching up to Ethereum in some way, or kind of, you know, taking some market share from Ethereum, tend to be more centralized, and that gives them advantages because they can be cheaper, they can be faster, things like that. But then they're also you know, somewhat less secure. And so I think that one of the biggest questions that we're seeing playing out in the smart contract space is the industry going to structurally trend towards ongoing centralization, meaning will things like Solana continue to capture market share, or will we hit kind of a peak centralization and you get too many technical problems, and then you revert back to some of the more middle ground ones like Ethereum that are, you know, they're not as decentralized as Bitcoin, but they're more decentralized than Solana. And I think that's one of the biggest questions to watch in the altcoin space. And I don't have a strong answer yet. I generally have been observing that trend towards centralization. And so that's kind of my base case. But it depends on how many technical issues they run into if they start to get that kind of pushback and kind of a reshuffling back towards decentralization. It's also a regulatory question. If for example, some of the former SEC people have decided that essentially Ethereum probably was an unregistered security in the beginning, but that it might have reached some level of partial decentralization, so it might not cleanly be a security anymore, whereas other ones still are. And if that ends up being the case, if other ones get cracked down as a security, but Ethereum escapes that, that could be good for Ethereum. And so there's that combination of technical challenges and regulatory unclarity about whether some of the more centralized ones will win versus some of the half centralized ones like Ethereum.
Yeah, this is the Solana Ethereum chart relative valuation. I'm a bit cynical. I don't think we ever get full decentralized freedom from the powers that be. So I think you're right. I like that observation at the security versus centralization. We do seem to be setting up. Solana could give up some ground now, maybe for a little bit of an off, but it does feel like it's going to gain ground against Ethereum. It is, of course, a smaller market cap, so it takes less money at the lower percentages. If I just take us back, what's the market cap again, Solana? We're in and around. It's 56 billion. It's you know, your Ethereum is almost 9 times bigger. So it's not, you're not a genius for calling that. It just does feel technically well set up. Not right now. I think you'll get a better chance to buy it a touch lower, but for higher up. And that would probably point to a couple of big winners in the slightly more centralized space. I'm going to leave this as the final question and chat because I think these things are all coming together. Central bank digital tokens are certainly getting closer to that eventuality, hence why we see maybe some Forex collapses under dollar strength, which could then precipitate the rollouts in a number of places. Then you've got the antipathy towards stable coins and DeFi, which is essentially monetary policy that the current realm doesn't have. So the central bankers that have had the monopoly on money supply resent the fact that people can get real savings rates paid to them for postponed consumption in a stable token or a wrapped stable coin, let's say. Obviously, a stable token, the value can lose, so we take it slightly, the APRs there slightly less seriously. But doesn't it feel like the central banks are coming for that reason? And the stable coins are the greater challenge, and they resent the fact that having totally perverted monetary policy so that we don't have real interest rate discovery, that they resent any new ecosystem that highlights a different market for postponed consumption on a currency equivalent like a stable coin. What's your final comment on how that all came about and your take on how it maybe resolves apart from regulation, which I'm thinking is almost a given?
I mean, China's clearly pursuing the CBDC route, and that's another catalyst for them is they want to launch that in 2022. They've already been testing it, so they're pretty far along, and they've been researching it since 2014, as far as I know, and they've been testing it for a couple of years now, and so that's a big force for them. In addition, it allows them, in addition to, China likes to surveil all their people's transactions and block things and, automatically take away money if they want for infractions of social credit score linking, whatever you want to call it.
I wish they're the only one.
In
Lynn.
addition, they also they want to be able to go around the SWIFT system. So if they have, they're the world's largest trading partner for the majority of countries, and they want to be able to go around the SWIFT system, and so they want to increase their reach globally with their currency. And so I think that's their big approach starting in 2022. I think the U.S. is going to take a somewhat different approach. There's a lot of pushback against CBDCs, and I think at least for a while, I think we're going to see more of this kind of public-private combination where I think stable coins are going to get regulated into banking entities. Either existing banks will be issuing them, or some of the stablecoin issuers like Circle. Some of these entities could become banks or merge with banks, whatever the case may be, and that we'll see a more regulated stablecoin market, and that'll be kind of an extension of the state. That'll be basically their version of a CBDC, which is somewhat more the American way of things, at least for this current era. Now, Europe, I think, could be somewhere in the middle. I don't really know how that's going to shake out. I haven't followed their politics quite as closely. I know they've been pretty aggressive against stable coins, but I think that we'll see how they transition. But I think that's kind of the United States versus China dichotomy, is that China's going to have the CBDC. The United States, at least for a while, is going to probably keep growing its stablecoin markets, but in more regulated ways. And then you have things like something like Tether is basically a type of Eurodollar. So we've had a multi-decade issue of Eurodollar market opaqueness, which is essentially that you have dollars outside the United States, outside of the purview of the Fed. It's a very opaque market. That's part of why we have these weird dollar spikes and things like that, because these countries owe dollars, but they can't print dollars. And so I think you could have these unregulated stablecoin type things that are essentially a new version of a Eurodollar. And so I think those will persist in some form, but they'll face increasing crackdowns in regulated areas, and so they're more of that offshore type of thing, rather than something you'll see on major U.S. exchanges. So I think probably you'll see the market cap of regulated stablecoins eventually outpace Tether.
And rather than some bonfire of the vanities, maybe some of these stable coins, because they want to encourage in crypto adoption, maybe these stable coins having to partner up with banking entities all face extermination.
Yeah,
maybe.
I mean, we've seen, for example, the government has published guidance on that, and that they pretty much laid it out that they want to have stable coins basically be banks. And so again, it could be that they get acquired by banks, could be that they acquire a bank, or it could be they become banks, or banks issue their own stable coins. We could have a variety of different outcomes. But I essentially think you're going to see that increasing merger and the tighter regulation. Part of it is they want stable coins to hold clean collateral, right? So if you're only backing your assets and liabilities one to one, you have to have those assets be entirely dollars and T-bills and things like that. You can't have other things. Now, if you're going to back them with riskier assets like corporate bonds, well, then you need a capital buffer like a bank. You need your assets to exceed your liabilities if you're taking on